Good afternoon. Thank you for joining us. This is a platinum gold spread case study. My name is Kevin Falkman. I'm a product specialist at CQG, and I handle the spreader product. Today we have Andy Hecht with us. Andy Hecht is a commodities trader since 1981. Andy was running all non-energy commodities trading at Solomon Brothers. Andy moved on to Cantor Fitzgerald as a commodity broker. Andy ran precious metals options trading at HSBC. And in 2003 started Radar Logic, a company that he runs. Today Andy writes, consults to hedgers in the trading community. On January 11th, Andy's recently released a new book published by McGraw-Hill entitled How to Make Money with Commodities. Andy's also working on his new book, Luster, The Myth and Mystery of Metals. This is a book that I understand is for the average investor looking for insight into how commodities affect the everyday lives of consumers. So we'll have some slides that Andy will show us, and I'll be handing this off to Andy in just a moment. Again, thank you for joining us. And we will also take questions at the end of Andy's presentation, so enjoy. Andy, good afternoon.
Hi, thanks, Kevin, and good afternoon. First, I'd like to thank everyone for attending this little presentation on a case study of a trade that I recommended on CQG back on November 7th. So let's get right into it. We'll start very basically. There are two types of market analysis, as I'm sure most of you all know. There's fundamental analysis, which is the study of supply and demand of a commodity. And of course, there's technical analysis, which is the study of price movements via charts. Fundamental analysis is usually done on an annual basis. It involves understanding total supply or production of a commodity, total demand or consumption of a commodity, and total stockpiles or reserves of a commodity. Fundamental analysis is used to determine if a market is in surplus, meaning more supply than demand, in deficit, more demand than supply, or in equilibrium, where supply and demand balance. Market prices and market direction are ultimately determined by supply and demand. I conduct fundamental analysis using a variety of different information and data sources over a period of time, as I mentioned, usually annually. Now, briefly, technical analysis is the study of price history using a variety of statistical analysis. And I'd like to kind of mention that for almost 30 years now, I've been using CQG, and I find it to be an amazing platform for technicians and traders alike. It's, for my money, it's the best platform out there in the market. So what I do is I use a system to look at markets, which I call Technomentals. It's just a combination of technical analysis and fundamental analysis. I use the fundamentals to determine market direction. I establish a medium to long-term market bias as to direction, and I use technical analysis to determine execution points for entering and exiting risk positions, and that's more of a short-term orientation, when to get in and when to get out. So let's look at this case study. On November 7th, I recommended to, in an article that I published on CQG, buying 2 contracts of NYMEX April Platinum, they're each 50-ounce contracts, and selling 1 contract, a 100-ounce contract of April Gold with a $170 discount for the Platinum. The spread was at a $170 discount, and I suggested using a risk or a stop of $220 under for the Platinum, in which case I would say I was wrong on the trade. But in my mind, the risk-reward ratio on this trade was much better than 2 to 1, which is what I look at as a minimum. On December 21st, I published a second article, and I recommended taking profits on half of the trade at $65 differential platinum at a $65 discount on half the position and to retain the balance of the spread for the ultimate target. On January 9th, the first profit target was reached, and anyone who followed my advice pocketed $105 on the spread, or $10,500 per spread, which was a pretty good return on margin. I think it was over 78%. And on February 5th, yesterday, the spread closed at a differential of $36 platinum to a premium to gold. As a matter of fact, today, I just looked at the market, the spread actually traded up to a $60 premium. The remaining position at yesterday's close has a mark-to-market profit of $206, or $20,600 per spread, and that's a return of over 150% on margin in less than 3 months. Basically, I'm looking for a $200 premium of platinum over gold for a total return of 175% on this trade. That is my target. So let's go into why I came up with this trade and how I looked at the markets in terms of platinum and gold. First, let's look at platinum fundamentals. There's production of 250 tons per year. 80% of annual production comes from South Africa. And within South Africa, 100% of that production comes from 3 companies, 3 mines: Anglo Platinum, Impala Platinum, and Lonmin Platinum. 15% of supply comes from Russia, and another 5% comes from the U.S. and Canada and Australia. But the majority of platinum, the vast majority of platinum, is produced in South Africa and Russia. As far as consumption is concerned, 3/4 of annual mine supply is used by industrial users, mainly for the production of automobile catalytic converters. Now, there's also some uses for fiberglass manufacturing, oil cracking catalysts, and some other uses because these metals, platinum withstands very high heat. But the vast majority, and the price is really determined by consumption by the automobile catalytic converter sector. Now, as far as stockpiles are concerned, there are very few stockpiles, as Russia, who held substantial platinum stockpiles in the 80s, liquidated these stocks in the early 90s when they needed cash and after glasnost. Both Russia and South Africa today need cash, so they sell platinum production as fast as it comes out of the ground. Production costs are rising. South African production costs are rising because mines are going deeper and deeper. And the deeper the mine goes, the higher production cost goes. All the cheap production was mined in prior decades. Some production costs today are higher than the present price in certain mines. Now, there were some other issues that happened back in late 2012 that affected my thinking on platinum. There were violent mine strikes in South Africa at the Lonmin properties that stopped production and raised production costs. Now, also, in 2012, 79 million automobiles were produced, and each one of those required some platinum for catalytic converters. And in 2013, there are expected to be 83 million automobiles produced as global economic growth increases and the demand for platinum goes along with that. And demand in Asia continues to be buoyant for automobiles. Let's look at gold. In gold, production is 2,800 tons per year. It comes from China, the #1 producer, Australia, the U.S., South Africa, Russia, Peru, and other countries. In terms of consumption, 50% is used for fabricated demand, jewelry. 40% is accounted for by investment demand, and 10% of gold goes to industrial use, dental, electronic, and so on. Gold has significant stockpiles. Every ounce of gold that ever has been produced in the history of the world still exists. 165,000 tons have been produced, and 20% of that production, or 30,800 tons, are in stockpiles and reserve assets held by governments around the world as a reserve asset for or as a foreign exchange asset. The U.S. government holds over 8,000 tons. Now, new instruments such as the gold ETFs introduced recently are a new stockpile, and it represents investors who have paper gold backed by gold that's physical in vault. The production cost for gold is rising as mines get deeper, and there are other issues surrounding gold. The long-term bull market in gold has increased investor demand. China, the world's largest producer, has been stockpiling gold, retaining production, and buying on the international market to increase their reserves. China is about to become the world's largest economy, but their gold holdings are small, only 1.8% of foreign exchange reserves, when compared to countries like the U.S., which has 76.6% of foreign exchange holdings in gold. Therefore, there's plenty of room for China to continue to buy gold to boost their percentage. So I gave you a little background as to the fundamentals of platinum and the fundamentals of gold. So let's look at where they have commonality. They're both precious metals. They're both rare metals. They're both sensitive to inflation. They're both coveted by investors for centuries. And they're both used as adornments for jewelry. And both have potential to be the ultimate reserve assets for governments and for individuals. As far as differences, platinum is more than 10 times more rare than gold. Platinum has greater industrial uses and less production. Platinum production is localized, South Africa and Russia, whereas gold production is more ubiquitous, more widespread. The supply and demand picture for platinum is historically tighter, meaning that it tends to go towards backwardation, whereas gold doesn't. Backwardation means that nearby prices for platinum can be higher than deferred prices. This very rarely, if ever, happens in gold. And platinum is historically more volatile with respect to price. I mean, for those of us who look at historical volatility, monthly historical volatility for platinum is 22.3% at last glance, while monthly historical volatility for gold is 11.8%. In fact, gold acts more like a currency than a commodity, where platinum acts more like a commodity than a currency. Let's look at a little bit of the technicals, the technical picture for gold and platinum, which gave rise to this trade that I suggested on November 7th. If you look at the chart that's up there now, on November 7th, the relative strength index, which I like to use to gauge bullish and bearish sentiment, was slightly oversold at 40. And the stochastics started to look relatively bullish to me in platinum on the daily chart. Let's take a look at a daily gold chart. On the same day, gold was totally neutral at 50 on the RSI, and the stochastics were slightly bullish, but overall gold felt to me and looked on the chart to be in a trading range, much more so than the platinum. Now let's go to a chart of the platinum-gold spread, a quarterly chart, which gives a lot of information. Over 25 years, platinum has traded at a discount to gold only 3 times. The average premium for platinum over gold during 25 years was $200. And in April 2008, before the financial crisis hit, platinum actually traded at a $1,140 premium over gold, which was an overextension in the other direction, but we'll talk about that later. 85% of the time, over 25 years, platinum was at a premium to gold, and that's on the quarterly chart. On a weekly chart, on November 7th, after a period of consolidation, the support level for the spread between platinum and gold rose, and the resistance level fell. This indicated to me an impending breakout, one way or the other, higher or lower. But based on historical fundamental data, I felt that the odds of a breakout in platinum favored the upside much more than the downside. So, let me just go to the next chart here. Okay, I use my Technomental analysis in order to look at fundamentals. Just to recap, platinum is rarer than gold, and it has a tighter supply and demand picture. Platinum production is more localized, and gold production is ubiquitous. Platinum is more sensitive to worldwide industrial growth than gold. Automobile demand has continued to grow on a year-by-year basis, driven by Asian demand. Signs of global growth appeared late in 2012, and platinum tends towards backwardation, gold does not. That recaps the fundamentals that drove me towards this position. Technically, platinums range between a $220 discount and a $1,140 premium to gold over 3 decades. It has only traded at a discount 3 times during that period and has traded at a premium 85% of the times. Platinum charts began to turn bullish in late 2012. Gold charts remained stable in late 2012. So my Technomental conclusions were that platinum should be more expensive than gold. During the discount period, execution time became of paramount importance. In November 2012, the technical opportunity aligned itself with the fundamental nature of the market, and a Technomental signal in November 2012 triggered a long platinum, short gold risk position to enter at a $170 discount and exit at a target equilibrium price of the long-term average, which is $220 over gold. So, what are the positives and negatives of Technomental analysis? Well, obviously, this trade went right. Positives are that Technomentals are of great use when identifying market distortions and execution points to take advantage of them. Distortions and market overextensions occur from time to time and offer the greatest opportunity for very large profits. But I have to caution, market distortions can present themselves for long periods of time. For example, the platinum had traded at a discount to gold for almost a year before November 7, 2012, when I recommended this position. Fears of slower global growth were in the market. There were a lot of reasons for it. And technically, the market wasn't signaling a risk position. But on November 7th, it did so. Another caution is, in August of 2008, platinum went to an $1,140 premium to gold, which was a gross overextension. Now, I found it easier to buy platinum relative to gold in November than I did back in August 2008 to sell platinum versus gold when it was at such a massive premium. You might ask why. Well, the answer is simple. There's 250 tons of platinum produced each year and 2,800 tons of gold produced each year. So in my mind, always, platinum should be at a huge premium to gold. The discount platinum was trading at to gold on November 7th was in place for over a year. But for that year, I had been looking for spots to purchase platinum and sell gold because of my bias on the fundamental side of it, of this equation. So the key to profitability in using Technomentals to identify opportunities is to identify the fundamental reason why the distortion will correct, to use technical signals to capture a reversal and a return to normal market conditions. And as you all know, as traders and technicians, when it comes to markets, timing is everything. So just because a market distortion presents itself, it doesn't necessarily trigger a risk position. The stars need to line up. Fundamentals and technicals need to work together to signal a risk position. I'll tell you a little story. I worked for the Commodities trading division of Solomon Inc. in the early 80s. I actually started there in 1981. And the division was called Philip Brothers, and it was a very large, probably the largest in the world, physical trading company for commodities. I mean, we traded everything from gold and oil to fish meal, fertilizers, just anything that traded as a physical commodity, a staple, an essential. Many of the traders there were old school. They only took risk positions based on fundamental supply and demand data. They didn't really care about charts. As the markets became more liquid, more technicians, and particularly the markets I talk about, markets like the agricultural, the softs, the metals, the energies, as they became more liquid, more technicians participated in the markets. Charts and technical analysis became an excellent tool indicating the direction, the short-term direction of the liquidity herd, as I like to call it. Technical analysis became a great roadmap and charts a blueprint for short-term price movements. Those physical traders who didn't pay attention to the technical aspects of the market got ran over in the 80s and 90s. But just as the physical traders got ran over by the technicians, the same thing can happen in reverse today. Technomentals, or the convergence of fundamental and technical analysis, creates the most powerful buy or sell signals that are out there. And technomental applications can be used in a variety of different markets, because in markets, history tends to repeat itself, and that's really what technical analysis is based on. Markets are cyclical. At the same time, gross market distortions occur, which yield amazing, profitable opportunities. These distortions can occur in any market, in individual physical commodity markets, as we've seen over the years in terms of markets spiking or doubling or tripling. We saw it in cotton a couple of years ago when farmers decided to plant more corn than cotton, and cotton went from its long-term average of 50 cents per pound to $2.27 a pound, over a very brief period of time, and then came back down. So these distortions can happen in physical commodity markets. They happen in futures markets, which reflect the physicals. They happen in inter- and intra-commodity spreads. The platinum-gold spread is a perfect example of that. It happens in the gold and silver spread. It happens in quality spreads. For example, let's say Kansas City wheat versus Chicago wheat. Happens in location spreads. For example, Brent oil versus WTI oil, or oil in the Middle East versus oil in Asia, or natural gas in the United States versus natural gas in China. It happens in processing spreads, crack spreads, oil versus heating oil and gasoline. It happens in crush spreads, soybeans versus soybean meal and soybean oil. It happens in time spreads, where markets go to overextended levels of backwardation or overextended levels of contango. It happens in ETFs versus the underlying commodities or securities or assets they represent. For example, we see it sometimes divergences between things like the GLD or the IAU and the gold price, between the USO and the oil price, between the UNG and the natural gas price, and between other even market-based indexes and what they represent. We see it in stocks. For an example, a stock like Herbalife, which has two hedge fund managers basically fighting against each other whether the stock's going to go up or down or someone's going to get squeezed. It happens in arbitrage. There's opportunities in arbitrage. As I mentioned, ETFs versus the underlying. Airline stocks versus oil or diesel prices or jet fuel prices. Oil refining companies versus oil prices. Gold stocks versus the price of gold. Now, we've seen a very large divergence recently in terms of the price that gold mining shares are trading at versus gold. And that's something to keep your eye on today. And we even see it in stocks like Starbucks versus the price of coffee. There are so many opportunities to use this technomental process in order to identify really profitable medium-term trades. Now, I wrote a book called How to Make Money with Commodities, which was released on January 11th. The book is really useful. I wrote the book to be useful for everyone, from the novice investor with assets in a 401k to advanced traders. The book explains what is important knowledge for all investors and traders in terms of commodity market action and data, and what to look at. Every one of us is a consumer of commodities. We all buy food. We all fill our cars with gasoline. Commodities are staples we use every day. We eat chocolate, we drink coffee, we eat bread. We use all of the commodities that trade in the futures markets. In 1975, there were 4 billion people on planet Earth. Today, there are 7 billion people, and population is growing fast. More people are competing for finite staple commodities, and wealth is growing in the emerging markets, particularly in Asia. Commodity prices will have increasing effects on all our investment portfolios as volatility and prices rise. It's very important for traders and investors to understand commodity markets. The nominal price of commodities, such as gold and oil and soybeans and metals and corn and others that are reported on CNBC, Fox Business News, the Wall Street Journal, and others are only the nominal prices and are only a small part of the story of commodities. In the book, I tried to arm investors and traders with knowledge on how to look at and how to analyze commodity prices, which affect stocks, fixed income, investments, and personal spending. And it all comes down to the structure of the markets, the price today versus the deferred prices, and one commodity versus another, or a commodity versus another investment asset. There's so much free data available to do technomental analysis. And the book teaches, I hope it teaches, what to look at and how to look at it. You can follow me on Twitter at Comstrat, C-O-M-S-T-R-A-T, Andy H, or on CQG. And I'll continue to write for CQG and provide my technomental actionable analysis. So please take a look at my articles, and I'm happy to answer any questions you might have about the case study or anything else to do with commodities at this time.
Andy, that was a fantastic presentation. Thank you very much. And just looking for any questions at this time. We can address those to Andy at this time. We've got a question coming in now from Liam McAllister. Liam's asking, is it too late to enter a long platinum gold spread?
Excellent question, and one that I expected, Liam. You know, it was a home run trade in my mind at a $170 discount. Of course, at today's $60 premium, the risk reward is really not what I'd look for on a medium-term trade. You know, this thing can actually back and fill quite easily on some short-term bad economic news, but I would still look to add, to put it on gingerly on dips if it trades below flat. I don't look for it to go back to $1,140. I'm actually have a conservative target of a $200 premium, which is a long-term average, but you know, I would not enter into or recommend that trade today. But if you're in that trade, I would stick with it. But I would probably use this trailing stop and probably move it to a $65 discount where we took our first profits.
Excellent, Andy. And one other question we have is just, if you would, please just repeat your Twitter address for this.
Oh, sure. My Twitter address is at C-O-M-S-T-R-A-T, Comstrat, Andy H.
Excellent. I've got another question for you as well, Andy, coming from Richard. Richard's wondering a little bit about your daily routine. If you have a daily routine, is there a certain sort of things that you do each day?
Well, Richard, I'm a writer now, and I write about the financial markets, so I look at the financial markets every day. I actually live in Las Vegas, so I wake up very early each morning, and actually before I go to sleep, I look at the European markets, and then I look at the U.S. markets, and I kind of hone in on certain things. Like right now, I'm keeping my eye on the action in gold mining stocks versus gold. I'm keeping my eye on the Kansas City wheat spread versus Chicago wheat, because I think that's an interesting trade right now because, for example, Kansas City wheat is used more by food processors here in the U.S., and when that premium goes up, it tells me that they're doing more hedging, and that usually tells me something about the wheat price. I look at the markets. I kind of do fundamental analysis all the time, and I look at markets that overextend. So I'm looking at things like coffee now because I think coffee has come down very sharply. It was all the way up at $3.10 a pound, and now it's trading at around $1.50. So, you know, I look for markets that are overextending, and then I follow them on a daily basis. I like to watch the market action. I like to see if the high-frequency futures traders are in there and what kind of distortions they're making in the markets. So, and of course I look at energy. I look at them all, but I look for things that are away from equilibrium. And, you know, I've been doing this for 30 years, so I kind of, on a quarterly basis, I look at the fundamentals and update, you know, what's going on. I do a tremendous amount of reading, and I try to take advantage of all of the free data that's out there. See, as I said, I've been using CQG for many years. I love to look at the volume, the open interest. I love to look at what traders are doing, where the speculative money is. I look at a commitment of traders data. So there's a lot of things I look at, but when I'm looking at a specific trade, I try to hone in on all of the fundamental and technical data surrounding that trade in order to pinpoint the right execution point, or whether a trade is even worthwhile. And again, risk reward has to be at least 2 to 1. I prefer 4 or 5 to 1 for me to actually want to do a trade.
Very insightful. Thank you very much, Andy. And another question coming in from Chad Sokoloff. Chad says he's been looking at platinum on a daily and weekly chart, and it's recently taken out the 13-week high. He's considering going long platinum here. What are your thoughts on that?
You know, Chad, I love platinum. I think that 250 tons a year of production is far too little in terms of what it's used for industrially, and I think that the price will go higher long term. However, the reason why I look at platinum versus gold and platinum on spread is because it's a less risky trade. First of all, I believe that the margin requirements are lower, and of course you want to always look at your return against margin. I think platinum itself is about $2,500 a contract or something like that, and if you spread it against gold, I think you get some benefit on that. And quite frankly, you know, platinum is very volatile. As I mentioned before, platinum has almost a 23% monthly historical volatility, whereas gold has around 11% monthly volatility. I think adding gold into the mixture dampens the volatility on the trade. But if with a gun to my head today, I would be long, not short platinum, but I would look to buy it on a dip because of its high historic volatility.
That's great insight. Wonderful. Thank you very much, Andy. And that was the last question that we had out there. Again, I want to thank everybody for joining us this afternoon. The webinar is being recorded and can be found at news.cqg.com. I want to thank my presenter, Andy Hecht, and we look forward to seeing you again in another webinar possibly.
Thanks so much, and I really appreciate everyone attending.
Have a great afternoon, everybody. Thank you kindly for attending.